Welcome to Investing for Beginners. Today we're diving into the world of company valuation. Whether you're an investor, a finance student, or just curious about how companies are valued, understanding these methods is crucial. We'll explore four popular valuation techniques: the price to earnings ratio, free cash flow yield, discounted cash flow, and reverse discounted cash flow. And to make things interesting, we'll provide some examples along the way. Let's dig in. First up, the price to earnings ratio, or PE ratio. This is one of the most commonly used metrics in finance. It tells us how much investors are willing to pay for each dollar of a company's earnings. To calculate the PE ratio, we divide the current share price by the earnings per share, or EPS. Let's say Google's stock is trading at $164 and its EPS is $7. That gives us a PE ratio of 23.4. A PE ratio of 23 means investors are willing to pay $23 for every $1 of Google's earnings. A high PE might suggest that investors expect high growth in the future, while a low PE could indicate undervaluation or potential issues. Next, let's talk about free cash flow yield. This metric compares the free cash flow a company generates to its market price, giving us insight into how much cash a company is generating relative to its value. Let's suppose Google's free cash flow is $60.7 billion and its market cap is $2 trillion. The free cash flow yield would be approximately 3%, calculated like this. A higher free cash flow yield indicates that a company is generating a significant amount of cash relative to its market price, which we can see with Google, which can be very attractive for investors. Now let's dive into the discounted cash flow method, or DCF. This approach estimates a company's value based on its expected future cash flows, discounted back to their present value. To perform a DCF analysis, we need to project Google's future cash flows and discount them using a rate that reflects the risks of those cash flows. Let's assume Google's projected cash flows for the next 5 years are $60 billion annually, and we use a discount rate of 8%. This is all for an example. After calculating the present value of these cash flows, we sum them up to get the intrinsic value of Google. If this value is higher than the current market price, the stock might be undervalued. This is for example only. Finally, let's explore the reverse discounted cash flow method. This technique starts with the current market price and works backwards to determine what growth assumptions are implied by that price. By using Google's current market price and discount rate, we can calculate the growth rate that investors expect. If the implied growth rate seems too high or too low, it might indicate that the market is mispricing the stock. To sum everything up, each of these valuation methods offers unique insights into a company's value. The PE ratio and free cash flow yield provide quick snapshots, while the DCF and reverse DCF offer deeper analysis. By using multiple methods, investors can gain a comprehensive view of a company's worth. Thanks for watching, and don't forget to like and subscribe for more financial insights.